Every time you buy an option, somebody sells it to you, and I can tell you almost exactly who: a market maker, not a trader with an opinion, a machine with inventory. And what that machine does with its inventory is, on most days, the single biggest force moving the market you trade. This episode is about that machine. Episode 1: The Machine. Here's the core loop, and once you see it, you can't unsee it. Step 1: you buy a put on QQQ. Step 2: a market maker takes the other side. They're now short that put, whether they like it or not. Step 3: they will not sit with that risk. A short put loses money if the market falls, so they hedge, they short sell shares against it, real selling, hitting the real order book. Step 4: price moves, time passes, volatility changes, and the amount of hedge they need changes with it. Step 5: they re-hedge, and then it repeats forever. Millions of contracts all day, every day. You bought protection. The market receives sell flow. Your trade moved the market, not because of your opinion, but because of their hedge. Now, the direction of all that forced hedging depends on one thing: whether the dealers in aggregate are long options or short options, long gamma or short gamma. This is the regime switch that changes the entire personality of the market. Positive gamma first. When dealers are net long options, their hedging leans against the market. Price rallies, their delta gets too long. They sell into it. Price dips, they buy the dip automatically, without a view. The dealers become a giant mean reversion machine, and the tape feels it. Rallies stall, dips bounce, everything reverts to the middle. Boring, sticky, range-bound days. That's positive gamma doing its job. That's why breakout trades die over and over in this regime. You're not fighting other traders, you're fighting an automated seller with unlimited patience who sells every push higher and buys every push lower because their risk model makes them. Now flip it. When customers have loaded up on puts and on chased calls, dealers end up net short options, short gamma, and short gamma hedging works in reverse. It chases. Market falls? The puts their short gain delta, and the dealers have to sell more as it falls. Market rips? They have to buy the rip. The stabilizer becomes an amplifier. This is where air pockets come from. This is why some sell-offs feel like the floor just vanished. Because mechanically it did. Every tick lower forces more selling from the biggest, fastest player in the market. And on the way back up, the same machine buys, which is why negative gamma rallies rip faces off. Momentum in both directions manufactured by hedging. One thing here, and it's the mistake almost everyone makes when they discover gamma. Negative gamma does not tell you the market is going down. It tells you the moves will be big. The direction comes from somewhere else. Flows, macro, news. Negative gamma is an amplifier, not a compass. Big moves, unknown sign, respected exactly that way. So, what do you actually do with this? In positive gamma, trade the range, fade the extremes, take profits at the walls. We'll map those precisely in the next episode. And stop paying for breakouts the machine is programmed to sell. In negative gamma, flip your defaults, do not fade moves, cut your size. The same trade now lives in a market where the daily range can double. Let winners run because trends extend further than feels reasonable, and widen your stops or the amplified noise will take you out of trades that were right. The machine on the other side of your trades has no opinion. It has inventory, and it hedges that inventory in a way that is forced, mechanical, and, if you know the regime, predictable. Dampened above, amplified below. Everything else in this course builds on that one idea. Next episode, the map. Where exactly the walls are, what a gamma flip level is, why some support is a magnet and some is a trap door, and the 3 ways the map lies to you. See you there.